Hi, friends. Welcome once again. So, in the past, we've looked at value creation and we've considered the process that we use in the traditional creation of a value for the company or for customers. Okay. So, value we've realized is in two ways. We create the value, we give it to someone out there who enjoys the value, but at the end of the day, this person also gives us something in return for our value. Okay, so we look at the traditional process where we define what value is to the customer who is about to enjoy this. Does he really recognize this as a value? We then create it, then we deliver, and we capture or measure it in our books. Okay, so that's what we looked at, and we delved into Mendelow's matrix, identify the kind of stakeholders we need to satisfy, those with high power or with low power, and those with high power with low interest, and then we try to know whom should we keep involved, whom should we keep satisfied, okay, and whom should we exert less or minimum effort. And after that, we looked at what the example that we need to present in terms of Chop Limited. Okay, so that's what we looked at in the very first situation in terms of value creation. Today, we're going to be looking at value creation again, the process itself. Okay, in terms of identifying, again, creating and measuring and capturing. Okay, so once again, this is a summary of the entire text that we're looking, and specifically we are dealing with chapter 2 of our performance management text. Okay, the performance managing performance E2 subject of the CIMA text. So we're simply summarizing everything in a nutshell. Okay, so in a brief, I'll share my slide whilst we navigate the sections of this particular topic. Very interesting topic. In life, you need to create value. In the workplace, you need to create value. At the in the school, on campuses, in your personal life. If you don't create value, if somebody doesn't find you valuable, honestly, then you're just wasting your time because the person wouldn't actually find you useful. So, even in the lecturing, in our academic practice, we need to ensure that we're giving you value for money, for what you're paying for, okay, whether you're funded or not. We need to give you value because you're spending time, you're exerting time, okay, in this particular scenario. Okay, so the value and in creating value, we've always identified that we've said that whom are we creating the value for? So there is a stakeholder group we need to satisfy. Therefore, it is always important to undertake a stakeholder analysis for us to be able to identify what and to whom we are creating the value for. Okay, what value are we creating? Whom are we creating the value for? So stakeholder analysis is broad. Honestly, it's broad, and it depends on uh, where you are heading to and what is driving you. If you are the type who loves ethical stakeholder analysis, then you will never finish with the analysis because it is very pervasive and material. It expands across board. Okay, it means that while you are sitting in the UK now, you should be planning on how to satisfy someone who is yet to be born in Afghanistan. It means that you need to even start thinking of aqua life, aquaculture, somewhere in the Mediterranean Sea in Africa, in the ocean. Okay. So ethical stakeholder analysis is broad and it has come under heavy criticisms of late because the critics say that, listen, we cannot do this, it's not realistic. But if you are the managerial stakeholder person who wants to undertake that stakeholder analysis, you are able to set boundaries very easily. Okay, you're able to set easy boundaries, and it helps you to clearly identify whom to satisfy and when to satisfy them. In the stakeholder and value analysis, we have four main dimensions or steps to take. The first one is to identify who are the stakeholders and what do they consider as value. So relevant stakeholders that we are creating value for, is it the customers, is it suppliers, is it shareholders, is it the employees? Identify these key stakeholders. After that, you rank and prioritize them. It's like the Mendelow's matrix. So try and rank them in terms of whom should we satisfy first and followed by who. Okay, so the one with the highest influence of the company should be given the highest priority. All right, afterwards we need to then establish and identify the needs of these high priority stakeholders. We are not saying ignore the ones who are not high priority, but we are saying that first is first. Okay, if you know that this shareholder, if we don't give him enough returns for his stakes in the company, does, if he withdraws his stakes, the company can collapse. What do? We need to satisfy him first. So after you've ranked them, you've prioritized their needs, establish it in order of priority, okay, and give them their needs. After that, you then, like I said, give them their needs. You formulate value propositions for stakeholders, for these high priority stakeholders. Let me put it that way. Okay. Then the cycle goes round. Then you come back to look at the medium priority, establish what they need, value proposition, create it for them. Then you come back to the low, the ones with low, okay, stakeholders, those with low power, low interest, and then move on, establish their needs and create their values for them. But there is one thing we should be careful of. In stakeholder analysis, you must always look for contingencies. Someone we think is of a low priority will one day migrate to become someone with a high priority. There are times where you see a stakeholder who holds just about 5% stakes. In the next moment, you realize that this person becomes a significant stakeholder. Take an example of Tata Motors. If you've heard of Tata Motors, the specific years I can't really remember. Tata Motors is actually for Indian company. It's an Indian company. They came down to the UK and tried to ask for some guidance, some help, some kind of partnership with a UK company that deals in Jaguar vehicles. Do you know what happened? They turned them down. In fact, it was quite a great disappointment if you read the story. Everything was just terrible. The owner of Tata Motors was just demoralized. He went back to India. He went back to India, restructured, put in enough effort to make sure Tata Motors works, comes up to light. And then 10 years later, he came back to the UK when Jaguar was on the brink of collapse and bought it. And evidence shows that he's not the majority, the significant shareholder of Jaguar Motors. So remember that the one whom we think is of a low priority can one day grow to become of a high priority. The one whom we think is of a higher priority can one day decline to become a low priority. So it is always important for us to always keep analyzing, okay, always doing the analysis, regularly reviewing it to ensure whether someone has moved, then we can easily adjust our ways, okay. Now, each stakeholder is normally ranked in terms of the following attributes. So if we should concentrate on the high priority, what ability does he have to change everything that we are doing? The ability to impose their will on the company, okay. Legitimacy. What legitimacy does that shareholder have over us? Okay. Legitimacy is a resource which is given to the company to operate by the society. So then when the society, the system accepts you, that please operate. That is legitimacy. They've given you that resource. It's an intangible resource. So there are some shareholders or some stakeholders, let me use the word stakeholders, some stakeholders who can give you that legitimacy to operate. Customers are number one. The government is number two. Yes, shareholders are number three. But assuming shareholders are giving you all the money to work or expand your businesses and customers are not patronizing your services or products, where would you survive? Why would you survive? Okay. And then again, we also rank these stakeholders in terms of urgency. Okay. How urgent should we respond to them when they make a claim? Quickly, or we need to delay a little? Okay. So these three things normally help in trying to establish the priority, the kind of significance we attach to a shareholder. So once we identify, we rank them, we can easily identify the needs, their contributions to the company, and how we benefit from them as a company. Okay. Think of this example. Think about customers. What are their needs? What are their contributions to the company? And what is the benefit to the firm? Think of employees of the company. What are their needs, their contribution and benefits? Think of suppliers, competitors. Okay, and undertake this stakeholder analysis and see how best you can rank them in terms of their legitimacy, in terms of their need, in terms of the power that they exert over us, and how urgent we need to respond to their claims. Okay, all right. So we're wrapping up now. Value creation is a central focus of any business, whether for profit or not for profit. It can be financial benefits. We get profit, we get income. It can be non-financial, okay, something we cannot put figures on. It can be something we can feel and touch, some we cannot touch as intangibles, okay. Sometimes it is not just limited to the past, it can cover both the past, the present, and the future in spans across different time horizons. So we should always ensure that when we are creating the value, don't just think of the tangible, the physical. Okay, what about the after sales services? What about anything that will cost us money but will end up getting a good reputation in the system? Okay. So we all have a large part to play. Any business, we all have a large part to play. In every business where we have human beings, stakeholders taking part, we all have a large part to play in order to create this shared value. Value which doesn't only go out to people who enjoy, but value that even benefits the company and other connected networks. Okay, connected stakeholders, whether they are internal, external, connected. Okay. All right. So again, there are 5 key elements we'll look at before we wrap up with this particular topic. 5 key elements that must connect and align to the value creation process. And they all come at a cost, yes. So the first element we look at is the partners, okay, the suppliers, the employees, even even sometimes we can think of the competitors. So these are usually high priority um, stakeholders. Even shareholders are also part of these partners. The idea here is that these guys or this particular element of the value creation process, they help us to assess the market. Shareholders will give us money to assess the capital markets, to expand our businesses. Employees, they will give us their technical know-how, their intellectual capital in order to process inputs into outputs, okay? And then suppliers, they'll give us the resources, the materials, the raw materials, and the technologies we need to operate. So for us to be able to succeed in this value creation process, our partners, we must establish trust with them. And we must also reward them accordingly for whatever contribution they bring on board to the value creation process. Okay. Remunerate employees properly. If you know this guy is indispensable, if he leaves, it will create a vacuum. Treat him well. Give him some good bonuses. Okay. Give him some perks so that you get him bound. Okay. Again, the next thing is the resources. And resources more looks at the suppliers because they give us the inputs which we need to convert into output to satisfy our customers. So resources very important. Suppliers. It can be our competitors. Sometimes our competitors provide us with the resources. Okay. And again, I will also say resources sometimes can also be the human capital, especially in the service industry. If you're an audit firm, who are your suppliers? It's the market, the labor market. They are the ones giving you the human capital for you to use in delivering your services. You don't produce any goods. Okay, so resources from a production point of view will more center on the suppliers of materials and inputs, okay, of technologies. But from the service, we can expand it to the labor market out there. Then we need the processes which we will deploy to transform these inputs into outputs. So if you have a production facility, of course, you always need the design, the methods, okay, the mode in which you will need to convert these materials, these resources into outputs, okay. So we need the design framework, okay, the scope, the structure within which we can always use to provide a variable output to those who need it, okay. Conversion of inputs to outputs. So the processes is very key. Then we have the activities. So the process is the design of the framework. Activities is how we deploy these processes into reality, okay. So process is the design, the framework, okay, the structure, the infrastructure that we need. Okay. So if you take a typical example, a food production company will have a structure, a design in which it's on paper. Let's say it is the architectural framework, but the activity is how we actually engage and deploy this. Okay. An audit firm will have its audit methodology. So, for example, KPMG has its CAM, KPMG CAM. Okay, so call it KPMG audit methodology. Is a methodology they use is different from the Ernst& Young GAM. Ernst& Young, theirs is called the Ernst& Young Global Audit Methodology. PwC have theirs, okay. That's the processes. That's the processes, okay. Resources are the staff, the labor market, okay, the chartered accountants who work. The activities is how they now deploy this GAM, this CAM, okay, these audit methodologies to convert the resources, okay, into outputs. Okay, you go to the client side, you want to audit, you use the process, okay, but you need to actually implement it. So one is more of a framework, an architectural design. The other is more of execution, implementation, okay. And then the final element is the output. At the end of the day, we need to produce some goods, some services that will meet the value proposition required of the end holder, of the end user, of the stakeholder. Okay. So these are the five main elements of the value creation. And then remember, we said in the initial situation, we said you identify, you create, you deliver, and you capture. So you have to deliver the value that you have created to the end user, okay, the customers, okay. Usually we will have to classify these into various dimensions. And when in terms of considering who gets what, we need to consider the segments. Are we producing based on gender or geography or social behavior or the income level or the lifestyle? If you are producing for women, remember what they need. If you are producing for a particular culture, remember what they need. Would they buy into a mini skirt, for example? Does it frown upon their culture? Okay. What about geographical location? If you are producing winter coats for Africa, you are wasting your time because the setting over there doesn't. How many times do you get winter in Africa? So look at the geographical location and also target the income status of the person. Again, you should also consider the channels, the means by which you are going to transfer these goods deliver these goods to the end user. Okay. It can be online. I sit in my house and instead of walking to Domino's to order a pizza, they give me a channel that listen, order it online and the driver will bring it at our cost. So consider the channel, the distribution channels, the sales, the marketing channels that you use to send the elements, the goods, the services, the value to the end user. Okay. And then the final element in our process is capturing it. Okay. So in accounting, we will simply say we want to look at the measurement and recognition of the value. That's what we're talking about, and disclosing it on the face of the account, of the books of the company. So we need to capture this value clearly. If it's monetary, if we are talking of monetary, financial, then consider the revenue we have earned against the cost we've expended and check whether we made a profit. Okay. So usually we are we are dealing with both profit and not for profit. It's true. But whether for profit or not for profit, do you know they always incur some expenses? They always have some income. Whether they will report profits or they will reclassify it as a surplus, whether they will record a loss and reclassify it as a deficit, it's still money in, money out. Okay. There's no way you can say I'm not for profit, so I don't get income and I don't spend some money. You surely get some money. So at the end of the day, it still comes to money. It still comes to money. Okay. There's something we got. There's something we've expended. What's the net effect? Okay. Did we break even? Okay. So in capturing the value, we could use a number of approaches. We have the cost model. So the cost model is the traditional one. We only looking at the processes, the resources, the price we paid for the resources. Typical. Okay. How much did we expend? But usually it works hand in hand with the revenue model, whether you are making profit or not. The revenue is saying that how much income did we earn from the goods and services we delivered. Okay, in terms of segregating the market into segments, into customer segments, into lifestyle, geography, what did each segment give to us? Okay, so we're looking at the revenue model in terms of what we gain, what came in, cost model, what went out. Okay, and at the end of the day, some would always want to look at the net effect. Okay, then we have the sharing residual value. So it is simply dealing with I'm not the only one who created it. A supplier helped me, a competitor helped me, the government subsidized some cost for me. Okay, I also got some technical know-how from the society. The society supported me. So it is a shared value system. We are not talking of just money in terms of cost we expended and the revenue we incurred. We're looking at the framework, the network of people who contributed in the whole environment of the value creation to the end user. Okay. Yes, of course, some of these networks within this particular value sharing scenario will also enjoy some of the value, but we look at it as in a holistic picture. Okay, so a whole continuum, a whole spectrum of guys who help to create this value at the end of the day. All right. We summarize and end it here. So technology has had a significant impact on business models, whether for profit or not for profit. COVID has exposed the need for us to always keep changing and evolving to be able to depend on technology to play our roles. Today, COVID has made audit firms not to physically go to the client's office, spend days, and risk themselves counting inventory or observing inventory counts. They send drones, and drones can easily go and do the inventory count. Interesting. Okay, so technology is helping a lot, and any business who doesn't catch up with technology always falls behind. So businesses must adapt to these changing technological trends if they want to increase the value they create for their stakeholders and if they want to typically also increase the value they create for themselves. Two ways: value addition, value distribution. If you want them to move high, we need to always consider the overall picture of using technology. All right, so we end here, just 21 minutes off the mark, and I hope we found it quite useful. We'll look at the next session in a bit. Thank you. See you soon. Bye.